Hi, I'm Amy Quackenboss, and I'm the Executive Director of the American Bankruptcy Institute. I'm pleased to introduce ABI's newest program series entitled Strategies and Perspectives. It is our goal over the next year or so to bring you a series of programs that share the perspectives of industry leaders regarding the strategies they use in achieving successful outcomes in complex Chapter 11 cases. Today's program brings together some of the key insolvency professionals in the Hertz case, one of the largest Chapter 11 bankruptcies in recent years. We have over 900 attendees for today's program, and we are also streaming on all of our social media platforms. The recording of the program will be available after the program at hertz.abi.org and on demand on the Bloomberg Law website. We would like to thank our sponsors, Kramer Levin, Moelis, and White & Case, and ABI Presidential Partner Bloomberg Law for supporting this program. Before I introduce you to today's moderator, I'd like to address a couple of housekeeping matters. There are several tabs below the video stream you are watching right now, including materials for this program and additional information on continuing legal education. Please note, we are not able to offer CPE for this event, and CLE is not being offered in all jurisdictions, so please refer to the tab for more information. At the end of the program, you will be able to see a survey pop up in the chat box. All registered attendees will also receive this survey by email tomorrow. You must complete the survey to obtain your CLE credit. If you complete the survey, you'll then receive an email asking you to complete an affidavit for your CLE credit. Our panel discussion is in approximately 60 minutes. Then we will have a 30-minute question and answer session, and our panelists want you to ask questions. During today's presentation, if you have questions, please type them in the question pane to your right. Our moderator will present these to our panelists during the Q&A session. We may not get to all your questions, but we will certainly try. I'm now going to turn the program over to Jeff Fuller, Bankruptcy Legal Analyst for Bloomberg Law, who will be moderating the program and the Q&A session that will follow. Jeff, thank you so much for moderating today.
Thank you, Amy. Hello and welcome to the Anatomy of the Hertz Chapter 11, a fascinating case with twists and turns, creative strategies, and lessons for restructuring professionals. Joining our panel today, we have Catherine Bologna, Managing Director, Structured Credit at Deutsche Bank Securities. Deutsche Bank was the administrative agent under an asset-based securitization structure by which Hertz financed its rental fleet. Next, we have Amy Caton, partner at Kramer Levin, Naftalis & Frankel. Amy serves as counsel to the official committee of unsecured creditors in the Hertz case. Next, we have Bill Darrow, co-head of restructuring and recapitalization and member of the senior leadership team of Moelis & Company. Bill was the lead investment banker for Hertz. And finally, we have Thomas Loria, partner and global head of financial restructuring and insolvency practice at White & Case. Tom served as debtor's counsel in the Hertz case. I'm going to start with Bill. Bill, could you provide us with a brief summary of what happened in the Hertz Chapter 11 bankruptcy case?
Sure. It's sort of a tale of two cities almost. As we'll all remember, back in March, April of last year, the world, and of course the United States specifically, since that's where Hertz is headquartered, most of its businesses were confronting an unprecedented event in the form of a global pandemic, which basically shut down the global economy. If you think back to the financial crisis, we used to joke that every company was down about 25 to 35% of revenue or EBITDA. But what we experienced in COVID was much, much worse than that. It's nothing we've ever seen in our careers. And travel companies, airlines, travel agencies, car rental companies were really the tip of the spear in terms of impact. They saw their revenues fall off. In the case of companies like Hertz, 75 to 80% of their revenues just evaporated. Airlines experienced actually more than that. And we were confronting a dynamic beyond the revenue decline where all assets were really declining in value, including the value of used vehicles. And as we'll learn a little bit later, used car prices are really important in the context of how Hertz runs its business. So at that time, none of us knew what the future was going to hold. Many people talked about a 3 to 4 year downturn economically. Hertz was sitting on about $1.4 billion in cash around that time period, and had significant payments coming up to be made to its securitization lenders in the form of rental payments. And many of us were really concerned as to whether the company would even emerge, meaning it could end up liquidating if the environment continued the way that it was. On top of the fact that we had significant declines in revenues, our used car prices, which really supported our asset values, were declining. The capital markets were completely shut down, so we really couldn't borrow any money. And our capital structure was very stratified with a first lien lender position in the form of revolver and term loan, a second lien credit position, and then a bunch of unsecured debt. We didn't have any flexibility to go out and borrow more money. We really were all in crisis management mode. At the end of the case, when I said Tale of Two Cities, we ended up finishing a case. So at the beginning, when the company filed for bankruptcy, the first lien was trading around 60 cents on the dollar, the second lien around 40 cents, and the unsecured debt in the teens to 20 cents, and the stock somewhere between lower than $1 and a couple dollars based upon various options perspectives. But at the end of the case, we paid off all of our creditors in full. We got, as Catherine will say, one of the biggest securitizations done to come out of bankruptcy. And our shareholders received at the time what we thought was about $1 billion to $1.2 billion in value. In some ways, higher recoveries on their share price than they'd seen in several years before the bankruptcy. So really kind of a roller coaster event for all of us. And better to end the case that way than where people feared it was going to end at the beginning.
Right, that's remarkable. Thank you, Bill. One of the most important aspects of the Hertz case was the unique financing structure. Let's take a few minutes to explore that. Catherine, what can you tell us about how Hertz financed its rental fleet prior to its bankruptcy filing?
Sure. The primary source for Hertz funding its business pre-COVID and still today is through the securitization market. That's both the private bank market as well as the capital markets. Hertz has been financing itself through this structure for over 15 years. It's a standard structure used by other rental car companies as well. At the time of the filing, Hertz's ABS structure included a 19-bank variable funding note and 11 rated term ABS that was held pretty widely by money managers, insurance companies, and hedge funds. So in total, there was about $11 billion of outstanding debt at the time of the filing in May, and that was secured by Hertz's entire U.S. rental fleet of about 550,000 vehicles. So those 11 deals were rated AAA by multiple rating agencies. And the vehicles in that fleet mostly were risk vehicles. And what that means is Hertz bears the residual risk on those cars. They purchase them from the OEMs, they use them in the rental fleet, and then at the end of their useful life, they're responsible for disposing of them. So the vast majority of the cars Hertz financed or purchased at that time, about 85%, were risk vehicles. The other 15% were what's called program vehicles, where the manufacturers will take the cars back at the end and they bear the residual risk. In the rental car securitization market, the structures are set up as a master trust, so a shared pool of collateral across all of the series of notes. The cars are purchased by that bankruptcy remote special purpose vehicle and then leased back to the rental car operator for use. So the lenders and investors in these deals are typically advancing about 80 to 85% of the value of each vehicle. And as the lessee in that structure, the rental car company, in this case Hertz, is responsible for making monthly rental payments, as Bill mentioned, to account for depreciation and interest as well as carrying costs. One important feature in these structures is the dynamic mark-to-market that we see of the vehicles. So the lenders care a lot about staying on sides that the vehicle value that Hertz is holding the cars at is consistent with the used car market at large. So there's a monthly test whereby Hertz has to compare the value of the vehicles on their books to third-party market values from sources like NADA and Black Book. And if there's a decline in those values, Hertz is responsible for truing up that borrowing base. Typically, they would do that by putting cash into the structure or by selling vehicles. And then overall in that structure, if there's not a true up or they're unable to complete that process, the remedy that the lenders have is to seize the collateral and liquidate the fleet. Obviously, the risk of doing that means Hertz would lose access to its fleet and thereby not be able to operate. So when COVID hit, Hertz was faced with decline in used car values, the need to true up its borrowing base in the ABS structure, and at the same time, as Bill mentioned, their revenues declined 75, 80% all at once. So that was the background of what was going on kind of in that period, couple months leading up to the filing.
Great. Thank you, Catherine. Bill or Tom, if you want to chime in, can you tell us about the Hertz's path into Chapter 11?
Well, Tom was there before I was. So, Tom, you want to start?
Sure. As Bill mentioned, we had this precipitous decline in revenue. And at the same time, because used car values had diminished, we had this enormous rental obligation. It was up to about $500 million on a monthly basis in April. And so we made the very difficult decision to not pay the rent. And that triggered defaults throughout our capital structure and necessitated negotiating a forbearance agreement so that we didn't have to file for Chapter 11 kind of as a free fall in April. We were able to get a short forbearance in place, about a month. And we're hopeful that when we educated our lenders regarding the difficulty of our situation and the adverse impact we thought a Chapter 11 case would have on the business, that we would be able to extend that forbearance and have more time to try to find an out-of-court solution. That didn't happen. So May 22, the forbearance expired.
Uh-oh. Did we lose Tom?
I'm back.
Great.
Sorry about that.
The internet.
Yes.
Let's see. Well, talk about how, Tom, could you talk about how, how the case was financed in its first stages once you filed?
So as Bill mentioned, we had well over $1 billion of cash on hand at the commencement of the case. And to the dismay of our secured lenders, we had moved the vast majority of that cash, which we believed was traceable to drawdowns on our revolver, into accounts that were not within the collateral grasp of our first lien lenders. So we had cash at our availability that about a little over $1 billion that we were able to use to continue operating the business without having to get DIP financing immediately and without having to get the permission of our secured lenders. In addition, the bankruptcy code gave us a 60-day hiatus from paying rent. So in addition to not making the April rent payment, we also had the runway of May and June to try to come up with a solution for our liquidity before we would have to resume rent payments.
And I just want to add on that the decision to not make that rent payment was not an easy one. we agonized over that at the board level, the management level for a very long time. This is a very old company with a proud history and proud name, but the decision between making large payments to the ABS lenders and preserving cash for the company in an environment where we didn't know if we were ever going to get cash from a third party. Was DIP financing going to be available or not? In April and May, the Federal Reserve had not really commenced all of its securities buying and flooding the markets with liquidity quite yet. So it really wasn't clear where the money was going to come from. But a lot of people thought we should just make the payments and sort of take the bet that things would turn around in the next month or two, or the business would turn around. And what we were very collectively focused on was planning, in the old restructuring language, plan for the worst, hope for the best, planning for a year-long plus downturn and trying to finance that ourselves without having to ask third parties for money.
Right. I want to bring in Amy here for a second. Amy, you represented the Unsecured Creditors Committee in Hertz. Please tell us about the composition of the committee, membership, and what the members' main concerns were in the initial stages of the case.
Sure. So the Hertz committee was composed of 9 members. We had 3 trade creditor members, but not your typical trade creditors. It was Southwest Airlines as our chair, SiriusXM, and AAA. So these are very large, sophisticated companies. We had Wells Fargo and US Bank as indenture trustees, the Teamsters Union, the PBGC, and 2 litigation claimants that were represented by Dundon Advisors. And I really have to give the US trustees credit here for putting a ton of thought into their selection. It was a very nicely balanced committee. We know that there were a lot of applicants for this particular committee. And the way it was structured, there was no dominating group of creditors. And each committee member really took their fiduciary duties very seriously. And I would tell you throughout the year that Hertz was in bankruptcy, spent hundreds of hours on Hertz. And I think for them, Hertz was a microcosm of the larger economic situation in the travel industry as a whole, which was really volatile and frankly very dire at that point. So learning about what was happening at Hertz really helped these committee members and their representatives think about their own businesses and the other credits that they were involved in. So in terms of our priorities, so when Hertz filed, unsecured bonds were trading as low as 12 cents on the dollar. And so this PAR case that we ended up having, where people are fighting about make wholes and post-petition interest, that seemed very 2019 when it filed. And so we were really focused on damage control. So first, we were very focused on ensuring that there wasn't a quick rush to a valuation at the bottom and a handover of the keys to secured creditors. And I really want to give Tom Loria, Bill Darrow, their teams, the Hertz board, full credit that Hertz was able to file with as much liquidity, breathing room as it had, and to leisurely shop for a dip, because that's what really created the value in these cases later on. And that action, I would say, formed a lot of trust with the Unsecured Creditors Committee when it was formed. And despite the fact that our bonds were trading, like I said, as low as 12 cents, we worked with Tom and Bill to make sure that we took advantage of the gift that Hertz had, which was ample liquidity for a few months, and make this into an old-fashioned restructuring. So the second thing that we were focused on was forming a plan of attack. With bonds trading again at 12 cents on the dollar, you have very little choice but to look at potentially creating leverage versus your secured creditors. And so we started doing a lot of work on exploring the leverage and potential lien and priority challenges that we had versus the secured lenders and the ABS lenders. We spent a lot of time with the documents and the case law, and I think came up with some really great legal theories that would have been fun to litigate had we needed to. So that's what we were focused on.
Great. Thank you, Amy. Tom, could you just briefly tell us about the lease rejection motion that was filed in the first couple months, and then we want to start getting into talking about the plan formulation process after that.
Well, as they say, necessity is the mother of invention. And we had 2 big problems that we had to solve. Number one, we had way too many cars. As has been mentioned, we had over 500,000 vehicles in the U.S., and the utilization was down around 10% of historic levels. And 2, we had a rent payment associated with those vehicles that we just could not sustain. It was on the order of $500 million a month. So in reading through the lease document, we concluded that there was an argument to be made that in fact, each vehicle was separately leased. And so one of the key components of our strategy with the ABS lenders was to take the position that we didn't have to reject the entire lease and lose all 500,000 cars, but rather we could reject the lease just as to the cars we didn't want or need. And I think this was something that they were not expecting. And it's something that they corrected in the ABS financing we did on the way out, so that they won't have to hear that argument again. The other thing we did is we planned to take advantage of the equities of the case doctrine in 365 to go to the bankruptcy court and make a case that under the circumstances, the survival of the company was dependent on getting a reduced rental rate. And we thought we could make a case under the circumstances that the rent should be reduced to $70 or $80 million a month. So we teed that up in order to really get a seat at the table with the ABS lenders.
Great. Catherine, can you talk a little bit about the ABS lenders' concerns in the initial stages of the case and then how that evolved?
Sure. The securitization structure is designed to be repaid, from the assets. So in this case, from the sale of vehicles in the fleet. So, from the beginning of the case in May, we were definitely focused on, Hertz's willingness and ability or lack thereof to sell vehicles into the market at that time through, any and all channels. So, that was the focus. How could the fleet get down? As has been said several times, that they had too many cars for the demand at that time. So, in that initial period, just as Hertz was preparing its strategy, we were able, as Tom said, to come to the table and I think pretty quickly reach what was the first of two interim settlements, where there was an orderly defleeting of portions of the fleet while allowing them to still use it. And then we did see demand start to come back, and then also allowed for partial rent payments to account for depreciation. So, that was throughout the course of June into July, the focus that we had in kind of reaching that settlement and being able to see the company continue to sell vehicles.
Thanks, Catherine. Now let's turn to the formulation of the Chapter 11 plan. Tom, you set a very ambitious deadline to emerge from the bankruptcy case no later than June 30th, 2021, a goal which was achieved. Why was this date so important?
Well, there were a number of reasons. Number one, the summer is really the company's make or break time of the year. People are on vacation, renting cars, and we felt that we needed to be out of Chapter 11 for the company really to be in a position to do what it needed to do to meet what we hoped would be a renewed summer demand. In addition, we were all early on in the case, we were starting to hear from various OEMs that as long as we were in bankruptcy, they would be unwilling to enter into new agreements to sell us cars. And what we learned previously was that if you don't keep your fleet refreshed and new, you lose business. So we were very concerned that if we spent that second summer in bankruptcy, that we would get an almost permanently aged fleet that would cost an enormous amount of money to bring current, and that might really permanently impair the business. So it's actually kind of funny. We sat down in late October and started educating the board about the plan process, and we laid out a timeline for things that we would have to do in order to exit Chapter 11 by the end of the second quarter, June 30th. And, we all felt that was when we looked at what we were going to have to accomplish, we felt that was a really ambitious timeline. In fact, I think probably everybody in the room would have said we didn't think we'd really make it, but we thought that if we set June 30th as the deadline for exit, that maybe we would have a chance of getting out in July or August or September. And if we didn't, it was highly likely that we would be in Chapter 11 for another business cycle. So we wouldn't get out until 2022. And, that may have permanently impaired the business. The other thing is, and one thing I'd like to go back and touch on.
Sure.
The rental car market, or the used car market rather, had really declined precipitously prior to the filing. But during that 2-month period where we had a rent vacation, the price of used cars suddenly spiked. OEMs were unable to meet the demand for new cars, so people turned to buying used cars. And that spike really propelled the case forward in a positive fashion. We were able to negotiate a deal with the ABS folks where we cut our rental obligation from about $500 million a month to just over $100 million a month. And an important part of that agreement was our agreement to sell vehicles and pay down the ABS debt. And in fact, by the end of the year, we had sold over 200,000 cars and paid that ABS debt down from about $11 billion to under $5 billion. And I think that was a critically important aspect of the case. It put us in a position to talk ambitiously about emerging from Chapter 11 in June of 2021. And I guess, together with that, I think there's another important thing. We all saw the potential for a lot of fights at the beginning of the case. And the fact that we were able to negotiate an agreement with our lenders that didn't require fighting over the use of cash, and the fact that we were able to cut a deal with the ABS lenders that preserved the company's liquidity, put us in a position to then be able to access the market for DIP financing in an orderly fashion and in a competitive fashion. And, competition turns out to be pretty important for all you socialists out there. The fact that we had a competitive market for DIP financing and later for planned sponsorship really propelled the case in a positive direction. But I guess I want to say, instead of fighting, because we were able to make those two deals up front, we put the company in a position, we created a tone for the case where I think everybody involved really sat down at the table as commercial business people to find solutions to the process rather than to pick fights. And that allowed our plan process to really go from a dream to becoming reality going into early 2021.
Great.
So Tom, can I just interject for a moment? Because I'm very glad to hear that you were actually bluffing a little bit when you gave us that June 30, 2021 date.
You didn't say bluffing.
I mean, I almost fell out of my seat.
I'm
when
an
you said
optimist.
it.
I'm an
Yeah,
optimist.
exactly. I mean, and we understood why it was so important to exit. But I mean, this wasn't even 6 months into the case. The bonds were in the 40s. It was long before the COVID vaccine was available. Nobody knew what was going to happen. And it seemed like a long shot, I'll say that. And we were worried about doing a valuation that soon for unsecured creditors and trying to go out and find bids. But, we went with the vision and told you we'd try to support it. And we had to, sort of come to the place to go find the best bids out there.
I'll just add, it was like the little engine that could. It wasn't like we were saying that to our outside constituents. This is what we were saying internally. At board meetings, we're talking about, how are we going to get out by June and what things have to happen. And I will say, Tom put together some really brilliant things to kind of make that happen. We solicited a plan that was a toggle plan that kind of came up over a weekend because we were losing some time. We didn't want to lose time. And I'll say, Tom was the taskmaster on that, sticking to the timeline. And he should get tremendous credit for finding ways to make sure that we did. But when you go back to that time frame of the fall of 2020, when the bonds were trading, when you were saying, Amy, maybe in the 40s at that point, the little edge of the could, we think we can, but the markets had come back very strongly. And Tom and I had lived through Delphi, and we still have the scars on our back from Delphi. And we kind of collectively said, we need to get the money while we can get it. We don't want to be in a position where the market falls apart again. And no one,
Right.
to your point, Amy, knew when the vaccine was going to come out, how it was going to work, was going to have another round of infections. And we knew we needed billions of dollars of equity to come into the company. not at 500 million, not 100 million, but billions. And we knew that there were funds running around looking to invest capital, private equity firms, and those things kind of work together. We had the timeline that was important to the company, as Tom laid out. We also saw that there was a lot of capital out there, for the getting. I won't say that when we were talking about it that we thought we were going to pay off creditors 100 cents at that point, but we did very much say we wanted to have a competitive process. We didn't want to hand the company to one constituency or another just because they happened to feel like they were the fulcrum. We felt that it was important to run a process and have that process competitively play itself out to get the best ultimate outcome for both the company from a capital structure perspective and liquidity, but also for the constituents and not leave anybody behind.
Great. Hey, Tom, can you tell us about how the initial disclosure statement that you filed, and then just how the plan developed up until the auction?
Yeah, it was quite a process. We had penciled in to get out by June 30th that we had to have a disclosure statement approved by the middle of April. And to do that, we would have to file a plan at the beginning of March. So we're sitting here in early January, and we don't have any sponsorship proposals. We do have 3 parties that are interested in buying the company, those being the ad hoc group of bondholders who viewed themselves as the fulcrum class and the de facto owners of the company. And then we had a group led by Centerbridge that had come in and expressed interest in sponsoring the plan, and another group led by Knighthead and Certares. And they had a bit of a strategic angle. Certares is a venture owner in American Express Business Travel and some other travel services companies. And so they thought that there was a business story to be told about kind of putting Hertz together with a travel services business and would build on the platform in that fashion. To our disappointment, though, by the end of January, we had coaxed each of those 3 parties to provide us with an expression of interest. And all 3 of them came in with a valuation of between 3.3 and 3.7, $3.8 billion, which would have cleared the first lien and the second lien and paid approximately a 20-cent recovery, I think, to the unsecureds. And we were really unhappy with where we were. And we thought that rather than going back and asking for new bids, what we did was we put together a straw man proposal and sent it to the bidders and said, hey, here's a deal that the company will do. And that was premised on a $4.5 billion valuation and a 70-cent payout to unsecured creditors. And I think Amy will tell you that her partner thought that we were mad and wouldn't have the nerve to actually put that out. And maybe we were mad, but we did have the nerve, and we put it out. And this was on February 10th, by the way. And to our amazement, I'm sorry about that. My screen keeps cutting off here. To our amazement, the Knighthead Certares group came back and hit that. In fact, they exceeded it. They came back with a proposal to value the company at $4.8 billion and to pay unsecured 70 cents and to enhance the company's liquidity over what we anticipated. In fact, our original structure had a liquidity hole in it that we didn't talk about, but was something that was going to have to be addressed. So with that proposal in hand, we went from kind of being nowhere on February 10th to actually filing a plan that was going to be sponsored by Knighthead and Certares on March 1 that reflected a 70-cent payout to creditors. And with that proposal on the table, we then went out to the lending community and said, we're going to have a disclosure statement hearing on April 17th, and we need the financing committed by then. Not just the corporate finance, which would include a term loan and a revolver, but also our ABS financing. So we kind of weaponized that initial proposal to drive the process. And we started saying, hey, you know what? The dream of June 30th is still alive. And so let's start marching. Now, the problem with the Knighthead Certares proposal was that it did not have firm commitments for all of the equity that it was going to require. So we basically told them, we're going to give you a month to convince us that you have the money. And in the meantime, we went back to the Centerbridge folks and said, hey, this game is still open. We're willing to change horses here if you can give us a topping proposal. And so we got to the end of March. We didn't have the money committed by Knighthead Certares, but we did have a topping proposal at 75 cents for the unsecured creditors from the Centerbridge group. So before we made the decision to change horses, we filed a plan, I think, on or about March 30th. Maybe it was March 23rd, as I think about it. That put both sponsorship proposals in it, and where we said we're going to pick one or the other, we'll let you know, which was kind of a crazy move. And a week later, we did in fact pivot to the Centerbridge proposal, and so we filed yet another amended plan that removed Knighthead Certares and made Centerbridge, Warburg, and Dundon our plan sponsors with a 75-cent anticipated payout to creditors. But we knew that Knighthead and Certares weren't done. We knew they were going to come back. And in fact, we gave them a little bit of help. They were short a couple of $2 billion. And we'd been approached by Apollo, who had indicated to us that they wanted to invest up to $2 billion in the company, but as preferred stock. And I had told them in February and March that we really didn't see that we would have a need for that. But as we were pivoting to Centerbridge, and knowing that Knighthead Certares wanted to stay in the game, we introduced Knighthead Certares to Apollo and said, see if you guys can come up with something. Now, the crazy thing, and you kind of learn your lesson as time goes on. So literally at about 1 o'clock in the morning, the day of our disclosure statement hearing, we get a fully baked proposal from Knighthead and Certares that now includes a preferred component being provided by Apollo, and for the first time contemplated a recovery to equity. They were going to unimpair the unsecureds, and they were going to provide a 50-cent cash payout to the shareholders, 50 cents per share. And when we got to court, the judge said to Judge Walrath's great credit, hey, why don't you guys think about this for a few days and come back? So we adjourned the disclosure statement hearing, I think, until the 23rd of April, and really tried to sit down and figure out how to take the next step. And what we did is we went back to the Centerbridge folks and got them to add to their proposal a warrant package that we felt was worth 90 to $1.10 a share. And so when we showed back up in court,
for the shareholders,
for the shareholders, right? For the shareholders. So when we showed back up in court on the 23rd, that's the deal we went with. And of course, the Knighthead Certares folks were very upset. We knew they were going to come back, and we felt that getting on the one hand, the opportunity to continue the bidding was great, but on the other hand, we didn't want to lose June 30th, which now looked increasingly unrealistic. So what did? As soon as we got the order approving the breakup fee with Centerbridge, we turned around and filed an auction motion, a motion to have basically a further bidding between Knighthead and Certares, and to have a hearing in a couple of weeks to approve whoever we pick as the winner, if there is another bid. But the key thing to the auction was we said, look, to hold our June 30th exit, which contemplated a June 10th confirmation hearing, we need the parties to not be able to continue bidding. We need to get to best and final and get this done by early mid-May so that we could hold our June exit. And to my surprise, we went to court to get that motion approved, and nobody objected. But, we kind of thought that Centerbridge would object because they feel that they already won, and we kind of thought that Certares would object because they needed more time, and we kind of thought that other stakeholders were going to say this was ridiculous, but nobody objected, so the court approved that, and that got us on the road to Miami,
Right.
which everybody I think probably remembers fondly.
Yeah, before we get there, Amy, can you tell us about what the committee was doing during that time period that Tom was describing?
Yeah, sure. So, look, the day of the auction was very exciting, and we'll get there. But really, as Tom was saying, the overwhelming bulk of the work on the auction was done in the months prior to that day. And, there was a tremendous amount of work done by Tom, Bill, people on the Hertz side, but also by the committee professionals trying to keep the buyers in the game and warm. And it was hard because when people are putting up a lot of money and they have a vision for a company and there's competition, they're never quite sure whether to stay in. And there was a lot of hand holding, I think, collectively done by everyone to make sure that our bidders stayed in. So that was really important to us. And then going back to that, how we got to that first 70-cent bid. And also we had some other things in terms of the plan process that were very important to unsecured creditors on, how to liquidate some of the disputed claims. We also came up with a straw man proposal, and I'd like to think either we came up with the idea first or great minds think alike, but we were actually preparing to send a straw man proposal from the committee out to the various stakeholders. And then when Tom said, well, we're going to do a straw man plan, and we ended up negotiating what that straw man plan was going to look like for the committee and for unsecured creditors with Tom in advance. It was all the better because it's clearly much more powerful coming from the debtors. So that was all good. So it was really, this combination of the various professionals working to keep the bidders in, making sure that, people had their financing. And also we had the challenge of dealing with the group of bondholders that I think was really intent on owning the equity and doing more like a club deal where they were going to try to, put in some money for the preferred stock and take breakup fees and, potentially not do as well by other unsecureds that couldn't participate. And I think to everyone's credit in the case, we were all determined that, yes, that has to happen in some cases. Every one of our firms has backed a case like that, but that wasn't going to be Hertz. And I think we got there by the time we got to the auction.
Great. Well, let's talk about the auction. What was the auction like?
They were the masked people and the unmasked people.
By midnight, everybody was unmasked.
It was wild.
Yeah. I think we had about 60 people down to our office in Miami, and there was a lot of grumbling about going to Miami, oddly enough. But people showed up, and we probably had 6 or 7 different groups that we bounced back and forth between. And one of the directors, Vincent Trary, who was former right-hand man of Carl Icahn, and very experienced in these types of situations, really with Bill and I, just kind of worked the crowd. We went back and forth. And, we got our initial responsive proposal from Centerbridge probably about 7 o'clock at night. We'd started at 10 in the morning. We got a response right back from the Knighthead Sotaris Apollo group that topped them. So the ball was back to the Centerbridge group. Sorry about that, folks. They struggled to formulate a proposal. And quite frankly, we thought they had the advantage because their proposal had included a very small amount of preferred. And we had told the Apollo group that they were limited, that their proposal had $1.5 billion of preferred, and they couldn't put more preferred in. We would not accept or consider a bid with more preferred. And so we thought that Centerbridge and that team had the opportunity to increase their bid with good currency by jumping up in the amount of preferred they would include. They really didn't do that. This turned into a battle of who was going to provide the most value through warrants. I guess it was noon the next day. We'd kind of got back and forth and gotten to the point where the difference between the two proposals was not discernible in terms of value. You could argue it one way that Centerbridge was ahead. You could argue it the other way that Knighthead Sotaris Apollo were ahead. So we called them together and said, we want your best and final offers, and we're going to give you an hour and a half to do that. So I think about noon, we got best and finals, and it took us until the end of the day to really come to a conclusion about which was best. And the reason for that was the crazy warrants that people had included in their proposal were really difficult to value. And maybe Bill would care to comment about that. But
Well,
I mean,
there. Part of the time period to evaluate the proposal was us going back to each of the groups to ask questions because it wasn't always clear. You like to say when we're in front of judges, well, it's not an apple versus an orange, it's an apple versus a lunchbox versus a skateboard. In some cases, it was even more divergent in terms of how to think about valuing pieces. And then there were different features that were attached to the different pieces that we needed to clarify. When you're trying to value an equity option, usually the theory revolves around a publicly traded instrument today. So it's pretty easy using Black-Scholes to value an option on IBM's stock. We were having to sort of not backwards engineer, because we do this in restructurings a lot, but sort of imply some of the inputs based upon observing what Hertz had done pre-bankruptcy in terms of its stock price volatility, as well as what was happening with Avis. And we ultimately established sort of a baseline volatility to use, which was interesting going into the auction before we got there. Lots of texts and complaints from the bankers for the different people bidding, the bankers for the bondholders, the bankers for the Centerbridge Warburg team, the bankers for the Knight Hester Taurus team. And the sort of funny thing was, once we kind of established a single unifying theory of what the volatility was going to be, it didn't really matter. We're just using one. Stop arguing about it. We're just going to use one, and we're going to work with that. And ultimately, people basically, grumblingly came around to that. And in Tom's summary, the things that we don't come out are, no one showered between whenever they got up on Monday morning and whenever they went home. In fact, there was a period where they asked us if they can go home and shower before they came back for us to announce who the winner was going to be. And we thought about it to decide whether we want to let them do that or not. And we decided to say yes. But between COVID and most people we think had been vaccinated, but there are still lots of unknowns out there. And masks and people not sleeping. And, Tom did bring in some food at 11 o'clock at night on Monday night. It was not the healthiest keep you awake food. It was kind of the opposite. It was, Cuban sandwiches and pizza. It tasted pretty good though. But that tension was just tremendous throughout the night. But it was a lot of hurry up and wait. We would come out and make an announcement, and then the other side would have to go to their conference room and figure out what they were going to propose. So we'd wait around, we'd walk around. I think I did more steps, according to my iPhone, during that period than is normal before COVID in Midtown Manhattan when you're walking from one office to another. Some people, were using those vaping cigarettes, the Juuls, and that was, then people were, having multiple espressos throughout the night. Then of course you can't understate the what those conference rooms smelled like by Tuesday morning. The stress and the lack of showering and the food. It was quite intense, and you could see the groups when they would come in to make a proposal and then determine a higher and better bid. They would be elated. The other team would kind of look down a little bit. There was some interesting strategy by the various bidders, but it was. I think it all worked out, obviously from an end perspective, extremely well. But the parties themselves, to Tom's point, that earlier decision to get the court to bless the once we're done, really worked in our favor to kind of keep moving things forward.
Great. Well, just talk a little bit about the result, and then ultimately the confirmation of the plan and the results that the case achieved.
Well, look, we ended up repaying all of our debt, including what was remaining under the ABS, in cash in full. When we started out, and that included our European financings. We had a total of about $19 billion of debt, including the ABS, the U.S. first lien, second lien, the unsecured debt, and our outside of the U.S. debt. We paid everything in cash in full. We delevered the balance sheet. We went in with about $6 billion of corporate debt in the U.S. We came out with $1.3 billion. And we went in, as I mentioned, with around $1 billion of liquidity. We came out with over $2.5 billion of liquidity. We had shrunk the size of the fleet from over 500,000 vehicles to around 300,000 vehicles, which turned out to be a lot more efficient and better for the business model. And we unified the European financing. Europe's financing is now included in the U.S. financing. So we put the company in a great spot. And really, when the court approved the winning bid, the Knighthead Certares bid, the confirmation of the plan was an afterthought. It was really an uncontested confirmation as a practical matter, and just an opportunity for the key stakeholders to do a victory lap, which everybody did. I think, with the exception of the bondholders, who decided that things were so great that they finally did have to have a fight, and that fight is ongoing with respect to whether or not make-wholes and default interest are owed. And we'll see how that comes out. That's in front of the court as we speak. But the biggest problem we had in getting out of bankruptcy at that point was getting the regulatory approvals in places like New Zealand and Austria and Bermuda and Ireland, where we had regulators who really didn't appreciate or understand the Chapter 11 proceeding. But we kept saying June 30th is the date. And at the end of the day, not only did people believe us, but we did it. We exited Chapter 11 on June 30th.
Great. Catherine, you want to talk about the results from the perspective of the ABS lenders?
Yeah, certainly once the plan process was underway, the fact that there were multiple, strong bidding groups, I think we felt very comfortable, in that debt that had been paid down, at that point in the spring, probably to $3 billion from the $11 billion, that we would be refinanced. And, the refinancing came in the form of a new securitization structure that, a smaller subset of the banks and investors who were part of the pre-petition structure participated in. And so, put in place $7 billion of committed financing through a new bank BFN, and then also a $4 billion rated term ABS, which is the largest ABS transaction that's been done kind of post-crisis. So that was a huge accomplishment for the company coming out of bankruptcy, to kind of have that strong restart in the ABS market.
Great. Amy, can you talk a little bit about the committee, for the unsecured creditors from the with respect to the results of the case overall?
Sure. Look, this may sound a little bit old-fashioned, but so much of the recovery value that was built, over the months of the auction process was really the foundation started with the trust that was built between the professionals in the early months of the case, and us sort of both keeping our eye on the main goal, which was maximizing recoveries for stakeholders and also having a strong Hertz at exit. So did we as committee counsel have our frustrations and our fights, behind the scenes with the debtors? Sure, you bet. But I think if we had spent a lot of time on those and had ended up, fighting things like the MIP and the keep and exclusivity and, various small things on the dip and the financing settlements, we would have just, made things worse off for unsecured creditors at the end of the day. And by focusing really on the end game and trying to work collectively with the debtors, and the debtors try to work collectively with us, I think we really improved the lot of all stakeholders in the case.
Mm-hmm. That's excellent. I'm going to move us into our question and answer time now. First question I have is, could you talk about the stock offering that Hertz proposed during the case, I guess the one that was pulled back?
Boy, I'm glad somebody asked that question. I was just sitting here lamenting the fact that we'd gotten through this thing without talking about the DIPO, debtor in possession public offering. Early on in the case, the stock of Hertz spiked up and traded to about $5 a share on heavy volume. There was a lot of talk about whether or not that was justified. Turns out that they were right. But we happen to have an active registration statement that was in place when we filed Chapter 11, and we had 250 million authorized shares that we could sell. So, we kind of came up with this crazy idea. We said, hey, as long as people want to pay $5 a share for Hertz stock, why shouldn't the company take advantage of that? If people want to buy shares, why shouldn't we provide them? And we couldn't come up with a reason. It was novel, but we felt that if we made good disclosure, which we felt that we did, I think the filing we made with the SEC said no less than 7 different places that the stock could well be worthless. So we asked the judge for permission to sell shares to raise capital instead of incur debt, which is kind of a no-brainer if you can do it. And it's kind of funny hearing. I was, for reasons I won't go into, I was stuck on the side of the road in my car. So I did the hearing from my car. The judge was so fascinated and pleased with this idea. I mean, Judge Walrath just thought, this is, if you can sell shares, this is obviously the best way to raise capital for a debtor. God bless. And then the big moment came when the SEC, who was at the hearing, spoke up. And the SEC's lawyer expressed no objection. So judge signed the order. This was on a Friday. Monday, we started selling shares. And somehow, with all the publicity around the idea that a bankrupt company was going to sell shares, the SEC changed directions. And by Monday afternoon, they reached out and suggested that we were going to be subject to an investigation and potential liability if we continued. So we shut down the share sale process. We'd sold, I don't know, maybe $30-40 million worth of stock by then, and went into a diligence exercise with the SEC, and ultimately concluded that they had just made it too hard for us, that they really didn't want us to sell the shares, so we abandoned that. I will note 2 things. Number one, imagine how the recovery to shareholders would have been and how the case would have progressed if we'd have raised that first $1 billion selling stock instead of ultimately instead financing. And number 2, I guess I just can't resist thanking the SEC, the watchdog and protector of the public investor, for having actually impaired and harmed their interests.
Thank you. Another question: why did Hertz need to file Chapter 11 when its competitors have managed to avoid it so far?
Bill,
Avis is the competitor everyone looks to because it's the public company. Enterprise is a private company. Hertz had about 2 turns more leverage and was more structured than Avis did. So Avis they could have at that point in time said to themselves, we can probably borrow some more money within the context of our capital structure. It may be expensive, but maybe we can borrow some more money. Look, our general belief when we represent companies is the last thing a company wants to do is file for Chapter 11. We don't go in there and say, hey, let me tell you about Chapter 11. It's so great. But in the context of a world where we had no idea where things are going, airlines, we had airline clients at that moment in time. Tom was working with one of the biggest suppliers to airlines at the same time. It was an apocalypse. We could not envision a reliable timeline when we'd get back to normalcy. And none of us believed, we were all defleeting, reducing our fleet sizes because we didn't want to pay for cars that we weren't using. And we also didn't want to take the risk on residual values, nor did Catherine's lending group. That residual values would keep going down, 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 down. So I used to like to say, rental car companies, we manufacture used cars. That's what we do. And in the interim, we rent them, right? We buy a new car, we sell it as a used car, and in the middle of that, we rent it out. And all 3 of those things have to work really well. Otherwise, we're going to lose a ton of money. And if we would have known that beginning in the early parts of 2021, all 3 of the car companies defleeting would have resulted in increasing average daily rental rates. So if you want to rent a car today, you're going to pay 3 or 4 times as much on average. We might have made different decisions. We might not have filed for Chapter 11. We might try to hold out longer. We didn't know. We were in the plan for the worst, hope for the best mindset. And at that point in time, in April, May, we hoped we would come to an agreement with our ABS lenders at some point, but we didn't know. We knew we had to use this nuclear weapon of rejecting the lease and arguing that it was every individual vehicle. And we had to kind of look at it as we may never see another dollar coming into the company for the next 12 to 18 months. So we have to survive on what we got. We got to get the beans and the old pasta out of the pantry and come up with some meal that's going to satisfy us during that. By the way, we all did that at home in the early stage of COVID, right? How many of us used tuna fish in more ways than we ever had in the previous 25 years? Bumblebee was a client of mine, so they were very happy about that. But, we had to make a decision at that point in time. And ultimately, obviously, it worked out. And Hertz has emerged at much, much better capitalization in terms of leverage and cash than Avis has probably ever been, maybe in 40 or 50 years.
I mean, looking at it from a bankruptcy professional, I clearly wasn't involved because we didn't come in later. You guys absolutely made the right call. If things had just gone even slightly differently, the company would have, potentially liquidated or been sold at very low values. So there's no question in my mind that it was the right time to file. You absolutely did the right thing.
One thing I would add to this,
Sure.
People will remember the company was about 40% owned by Carl Icahn pre-bankruptcy. So when we went to the feds hat in hand and asked for a government loan, we were kind of told sidebar that as a matter of public relations, the government just couldn't lend money to a company that was owned by Carl Icahn. And so we were not able to tap into that liquidity source that so many of the other folks in the travel space were able to.
Right. A question for Amy. Somebody was wondering, I guess, how Southwest Airlines managed to be on the creditors committee. Just didn't understand. I guess that some information about their claim, I suppose.
Oh, sure. So I won't go into too much detail, but Southwest Airlines had a very large partnership with Hertz where they prominently displayed, Hertz advertising on their planes and also had contracts with them in terms of sort of sharing programs. So they were a big travel partner of Hertz. I'm not quite sure where the contract stands today or what's happened there, but they were going through some similar sort of questions in their mind with respect to what was happening in the travel industry, albeit from a far greater position of financial security. So,
okay. Another question: how were you able to move the cash into unencumbered accounts and then prevent the secured lenders from asserting security interests on those accounts? I guess they're probably wondering, how did the debtor manage to have all this cash unencumbered in the early stages of the case?
Well, one of the things that was clear is that draws on a revolver, the proceeds of those draws, were not encompassed in the concept of cash collateral under our loan documents. The cash collateral was the proceeds from renting the cars. And when we filed Chapter 11, we took the position that 552 cut off those liens in the post-petition cash. But so when we drew the last $800 or $900 million down on a revolver in March, I believe, we knew there was a possibility of a default and an insolvency. So we just put that money in a separate account and kept it there as rainy day money. Now, there was some leakage that created some arguments about the possibility that there was a lien that could attach to the cash. But we thought that the better side of the position was that the money was unencumbered. And, ultimately, we kind of strung out arguing about that. And we had a lot of conversations with the committee and Amy and her team about how that fight was going to go and when we would have to have it. But every time it got teed up, people were able to come to an agreement to kick the can down the road. And once we got into the plan process, I think everybody saw that the first lien was going to get paid in full. So nobody really had a reason to fight over the cash collateral at that point.
Okay, thanks, Tom. We have a person who's curious about what steps were taken with respect to foreign subsidiaries and affiliates to deal with the repercussions of the Chapter 11 case in the U.S.
Well, we actually were prepared to file a number of the key foreign entities in the Chapter 11 case. And we threatened that to their lenders and got them to agree to give us a forbearance. And I think, everybody saw that a Chapter 11 case for these foreign entities was going to be a mess. And so people were willing to kind of go along with it for a while. I think the initial forbearance got us to September when we thought we were going to run out of money in Europe. We extended that and came up with another crazy idea. We filed a motion to basically have an auction of the euro notes, and the committee really didn't like that. And I think if we'd ever had to go forward with that, it would have been a big fight.
It was a brilliant idea, as we all thought on our side.
Right. So we ended up not doing that, but we got that lender group in Europe. They were owed about $1 billion to kind of engage with us and try to work with us on a constructive path forward. And as the planned negotiating process got going, one of the key things we asked both bidders to do was, a way to win the auction is to provide for the payment in full of the euro notes, which ultimately became a component of both proposals. So I guess it's, we convinced everybody that we had our finger on the button and that we were prepared to push it. But in the end, we didn't have to.
Great. Thanks, Tom. We have a question. Somebody wondering if you could explain how the warrants work, if they're issued only to shareholders. Are there more warrants that are kept by the debtor and distributed later?
So no, they were created. I mean, typically in a situation like this, these are common stock purchase warrants, so the right to buy a share of stock at a certain price. So the variables that people focus on are how long will I be able to do that, the duration, the lifespan of that warrant, 3 years, 5 years, 7 years are kind of the typical ranges.
Or 30. Or 30.
Or 30. And then the strike price. At which price can I buy the stock? And those were only created for the purpose of giving a currency to the existing Hertz common shareholders at that time. So there's not more that are out there. And we talked about the fun of the Miami experience. So both groups were working with a 10-year warrant package, just different quantum. And when the Knight Hertz group came in, they just took their duration to 30 years, which created a lot of snickering and guffawing and stuff like that in the room. The Black-Scholes model is not meant to go out that far, but you can plug in years, and it does create a calculation. We looked at that and said there is value in that, to having that 30-year option out there, but we really valued it based upon 10 years, similar to the other group. So it was just that amount that was created. I don't remember exactly the percentage. Tom, do you remember? Was it 15?
18%.
So the 18%, meaning they had the right to buy approximately 18% on a fully diluted basis of the common stock with that warrant. So a pretty big amount as well.
And it went to all shareholders.
Yeah.
Okay.
By the way, that was an important part, was that we wanted to make sure, because sometimes you have these dynamics where, like in a rights offering, only accredited investors, institutions, or rich people can participate. And one thing that that White and Case and Moelis, but particularly the board of directors and Vincent Drury, was really, really making sure that we could deliver real hard value to all shareholders, not just institutional. So the cash went to all shareholders, the warrants went to all shareholders, and the common stock that they received went to all shareholders.
Great, thank you. We have a question. Somebody was wondering, how did you manage the regulars of foreign jurisdictions? I guess what were the mechanics of doing that?
How do we manage the regulators?
Mm-hmm.
Well, we told them all that Hertz was going to emerge from bankruptcy on June 30th, and they did not want to be in the spotlight as the reason for holding that up. And behind the scenes, we actually developed a strategy that we were going to leave one entity in bankruptcy and we would transfer ownership of the foreign entities where we did not have regulatory approval into that entity so the company could emerge and we'd leave back some pieces. We cut a deal with the sponsors where if we did that, we'd have a period of time to get the regulatory approval, and failing that, we would liquidate the assets of those entities and distribute the proceeds to the sponsors. I mean, it was amazing. I can't remember. I think New Zealand was actually the first one to truncate their process and give us approval. And once we got one, just the dominoes seemed to fall. I think Australia, Bermuda, and the last one was Ireland. We have an insurance business in Ireland, literally 3 or 4 days before the scheduled closing, we got the final approval.
Right. Thank you. Can you speak a little bit to, I guess, how going forward, how Hertz will be able to preserve its relationships with its OEMs? I guess this with respect to but buying new vehicles. I mean, is there anything that is advantaged with Hertz with going forward from Chapter 11 the way it is now?
Buying vehicles is difficult across the board right now with the chip shortage and various other interferences in the supply lines. New cars are hard to come by, including for all three of the big rental companies. But the fact of the matter is we have a better balance sheet. We have more liquidity. We're a better customer than we were going into bankruptcy. So to the extent there has been an opportunity, we have been able to resume buying cars. And in fact, I'll note, one of the amazing things about the condition of the finance market, when Hertz exited Chapter 11, the aggregate cost of that $7 billion of new ABS financing was about 1.6%. And that's not 1.6% on top of a spread. That's 1.6% all in. And I've just never seen anything like it. But when you've got cheap debt and you've got a healthy company, people who have cars will sell them to you.
I guess that interest rate is why we're all so slow right now.
Just build up the future inventory, Amy. That's all it's doing.
Right.
Let's see. It's like HTZZ stock is trading well above the warrant strike 1380, but only 3% of the shares are floating. Was that limited float by design or a board consideration?
Well, all of it wasn't. I don't know that it was intended to be that way, but all of the rest of the stock, the other 97%, went to a relatively small group of investors, and so that stock came out restricted. And will only be freely tradable when we get a registration statement in place with respect to those shares. So, pardon me?
Sorry.
So
my phone came
it
up.
certainly
Sorry.
wasn't by design, but it was legally required. And so our expectation is that sometime in the near future, there'll be a registration statement and you'll see a larger trading volume. But at this point, I think everybody's pretty excited about the fact that the stock is trading at near $30 a share.
Great. Catherine, just a quick question for you. Is there any concern in the ABS lender community? We briefly touched on the lease rejection votes and treating the master lease as individual leases. Is there any concern that somebody like Tom Laurie is going to try something like that again?
Well, I mean, I think Tom mentioned this at the beginning, in all of the rental car securitizations that have been issued subsequent, including Hertz's $7 billion, there's explicit language that describes the master lease as, one indivisible lease, not severable in bankruptcy. So, that certainly, I would say, is an important point. When we were out road showing the ABS deal, that question came up time and time again. So it's definitely something that ABS investors care about. But I think, that language sort of speaks for itself.
Great. Thanks, Catherine. Let's see if we've got any more. Not seeing anything. Anybody else have anything that they didn't get to cover during the session that you want to talk about?
Look,
I would
the only
only
I just
mention
say
that
is that go ahead. Well,
I was just
I
going to
think
say that we
these
recently had
dynamics
a
sometimes
closing party to celebrate the successful conclusion of the Hertz case, and we gave out gag gifts to the various constituencies. That was something that they wanted but didn't get in the case, and the committee's packages were empty because they already got everything they could possibly want during the case. Great job.
Thank you. It was definitely an extremely successful case, but a lot of work to get there, right?
No, I'll add just a compliment to Amy. Most of us were there in person at the auction. And if you have to zoom in to a room full of people, we're probably experiencing it a lot more now these days than we did maybe a year ago. It's very awkward and cumbersome because everyone's in the room. It's very hard to read the room. And we would get back together at inopportune times, like 2:30 in the morning. And in the big conference room at White & Case in Miami, there were some very large TV screens. And some people didn't realize they were on camera, and you might have seen them putting a breakfast burrito in their mouth, things like that. Not the most palatable thing. But Amy always, no matter what time of the night, she always looked completely ready for the interaction. But more importantly, it was very hard when you're on the screen to interject into the process. And when there's a lot of people talking and back and forth, and I give Amy a lot of credit for maintaining her calmness during some very frustrating moments, but also, more importantly, interjecting at important points along the way where we really needed that perspective. So if maybe the other prize she should have gotten was the master of zooming. Because that was not easy to come in over that 80 or 100 people who were all very agitated and tired and in some cases unhappy.
Yeah, it was like I was the voice of God coming over, right?
It did come across that way. It did come over.
No, it is funny. Like from the committee's perspective, we had an entire case, and for professionals other than the auction, and I haven't met some of my committee members. And the fact is, like when we finished this case, I was very emotional when I was sent.
Oops.
I think we lost Amy.
Oh,
I guess we were all
There she is
lost in my
again.
emotional moment. I was saying I felt like going through the year of 2020 and 2021 together, both with our committee and with this group of people, it just it was very nice to come out on the other side of it. And I feel like even though we weren't together in person, we formed a lot of relationships that were really meaningful. So that's all good.
that's great. Well, I want to thank everybody on the panel, and I also want to thank our audience for joining us. I'm going to turn it back over to Amy Quackenboss for closing comments.
I'm here. Sorry, my mute button was not turning off. So thank you, Jeff. Thank you for moderating today. Thanks, Bloomberg Law. And also thank you to Catherine, Amy, Bill, and Tom for sharing your excellent time and insights with our audience today. Really a fascinating case study. And I'm sure there's so much more to talk about, but we're so glad you were here with us in the short time we had together. I'd also like to say thank you to our sponsors again, Kramer Levin, Moelis, and White & Case for supporting this program. For those of you in attendance who are wishing to claim CLE credit, please remember to complete the survey that should appear in the chat box now or soon, and will be in tomorrow's follow-up email. Both the survey and email have instructions on how to claim that credit. And you will also, in tomorrow's email, if you're registered and we have your email, you'll get a link for today's presentation as a recording. And of course, we'll be posting this recording up on all of our social media outlets and on our website because it was so fabulous. Thank you again for attending ABI's inaugural Strategies and Perspectives program. Be on the lookout for another in this series in the coming months. And be sure to take a look at abi.org/events for additional programs from ABI. Have a great afternoon and stay safe.